Is it going to record properly with this full screen? Okay, let's see. So the first question is, let's address Tanya's question first. Okay, so she had a bullish view on the underlying asset, and she had a bearish view on the eyeball chart. So therefore, she decided, according to our remember our decision matrix. We have a option trading decision matrix. Okay, so based on that decision matrix, so she went short a put option. Okay, but then she found that she was actually, let's say she sold the put option at $3, and then after some time she found that the option has actually moved to $3.50. So she's losing money on a short put option. And she found that even though the underlying asset had gone up a little bit, okay, the eyeball view had gone wrong. Okay, so the eyeball had gone up instead of going down, and that's what had pushed the option price up. Remember, because if option prices, because this is basically, if you go back to your option price calculator, the eyeball will be the input which will give you a model output, this model output will be equal to the market price, right? So whenever you increase the eyeball, the option prices, I think we'll just reduce this volume. No, I'm a little afraid it might actually then mute my microphone volume. Let's live with this nuisance. Okay, so if the eyeball goes up, the option prices will go up. Okay, that's why we have this relationship. So therefore, what must have happened? But in terms of what you have experienced, this is exactly why you see why option trading is a little more complicated than pure spot trading. What you did in your previous project. Okay. Because now you've got another problem to deal with, but actually you've got even more problems. Mainly we focus on eyeball and the underlying asset movement, underlying asset price movement. But there are other aspects also. Interest rates can also have an impact. It's not a huge impact. Then changes in the dividend, all these kinds of things can have an impact. But the point is there are many variables involved. Okay, when you're doing option trading. All right. Okay, so this is another problem. This is what you have experienced firsthand. This is what happens in the world, because the relationship is mathematical essentially. Okay, there are some other factors also, but mainly the value of an option is, remember the old formula that we saw, and that's on that website that I gave you, Options Education, the one which is run by the Option Clearing Corporation. Okay, that website which shows you option value. The total option premium consists of intrinsic value and time value. Okay, and where does so fit everything into the framework? Where does the intrinsic value come from? What is driving the intrinsic value? Yeah, to be more specific, you have to say that it's being driven by the relationship between these two. Okay, the exercise price and the underlying price. Okay, it's being driven by the relationship between these two. So once you buy the option, once she sold a put option, the exercise price is frozen. Okay, you can't change the exercise price. But what is not frozen is the underlying price. That keeps moving around. So what is driving, one of the major factors driving the option price is the relationship between the underlying price and the exercise price. And since this is frozen, essentially is the movement of the underlying asset price. That's one major factor driving it. The other major factor driving is as you can see, the eyeball. The eyeball keeps moving around because option prices keep moving around. And all that the model is doing is basically the model is recalibrating itself to find out which vol input is consistent with the market price. Okay, and will give me the same model output which is the same as the market price. So actually the model is chasing the market price. Okay, so now the eyeball keeps moving around because option prices keep moving around. Okay, through the pressure of the demand and supply. So now this is another major input, another major driver of the option price. Okay, the eyeball. Okay, so therefore now obviously whenever you have two factors, this is quite clearly written in your notes also. I don't want to go back right now, but you'll see in your own notes, it's quite clearly written that there are two factors. So the impact of one may outweigh the impact of the other, right? So in your case, your underlying asset view was correct, and the underlying asset price did move up, but the magnitude of that movement, or let's say to be more precise, the impact of the magnitude of that movement on the option price, okay, was not sufficient to outweigh the negative impact on the option price from the rise in eyeball. Negative impact, actually option price went up, but the negative impact on your P&L, right? Because the eyeball went up more, then the impact of the rise in I vol on the option price was much more than the impact of the movement in the underlying asset price. So this is something that this can jolly well happen to you. This is why I say that you have to focus on the I vol as well, and this is one of the lessons you learn when you do option trading, that you can be right on this. So in this case, she was right on her underlying asset price view, but still she lost money because she was not wrong. She was not right on the I vol view. Is this clear? Use the mic if you can.
Trading connection lost.
We have lost the internet. Okay.
If we select the call option for a later date, it should show the I vol that is expected.
No, you were talking about a put option. Now you're talking about a call option.
Any option.
Okay. No. Now you're talking about not your original problem. You're talking about a new problem.
In that side on optionistic,
Yeah.
if I choose a call option, say for 8th of November, or
You can't choose a call option here. You basically, this is where you take a view.
no, sir, we can choose it over.
Here you're talking about the option chain.
There was option.
Trading connection reestablished.
There are many options. Okay, let's go. Let's hear your. This chart is 1 minute. This chart is only the see when you get an I vol chart, whether it's on the optionistics, okay, or on the TWS option trader also you can get I vol chart. That is more like a. I haven't tried their time series charts on I vol. They actually have the cross-sectional data charts. Or if you're trying this one, I volatility, which is a shorter time frame, here you can see the Oracle I vol charts in orange. Okay. Whenever you're seeing this, these I vol charts are generated by taking average price of both puts and calls. Okay. So therefore this is an I vol index which is constructed, because strictly speaking these I vol charts typically that you see, you don't normally see them for one particular option, like the 65 December call on Microsoft. But that's a particular type of, but that's a particular option, okay, a particular contract. These I vol charts are not constructed because there are so many contracts. As you can see here itself, you can see so many, well, this is not the particular view, but as you have seen before, there are many option contracts in any given situation, right? Even on Microsoft stock, common stock, you'll have many, for any given expiry, you'll have many options, contract, many different strikes, many different expirations, okay? Each of those is a contract. Each combination of strike and expiration and specifying call or put, that becomes a particular contract. So these charts are generated by averaging out those contracts for a particular expiry. Okay, taking the average of those prices. Yeah. So coming back to, what is your question on call option? If you go back to optionistics, yeah.
On the same side, I get to,
Voice is not coming through the mic.
then on the same side, I get to choose which call option and which strike price am I looking for the chart for.
Okay.
I don't know why I'm coming here.
Okay, I don't want to do it here now because this is banned. This site is banned, right? So it may not respond. So I don't want to lose my picture here. Okay. Yeah. Okay. So I know you can do a lot of other stuff on this website. There's part of it is free, part of it is paid. Okay. So you can do a lot of stuff. But the general principle, what I would in general, I think what you're highlighting is a phenomenon. Are you guys able to follow what she's talking about? Right. Okay. So now. So what she's saying is she's tracking the I vol of a particular option contract. So in general, I would suggest that you don't track the I vol of a particular option. Okay, you can still do that, but first you should learn how to track the I vol charts for long periods of time, which are constructed as an average of all option prices for a particular maturity. Okay, so those are average indices. That's why you can see here it says IV index. You see here it says IV index. It doesn't say IV of a particular contract. It's IV index. Okay. All right. Who is talking here constantly? Who is this? Very disturbing. Don't talk while we are conducting. There should be no noise at all, or any other kind of activity when we are conducting the class. Okay. So so this is basically it. So you can also, what you are doing is going one step further and tracking the I vol movement of a particular option. You can do that also. That's finer analysis. So if you do that, what was the problem you faced?
The I vol was bearish, but in that view. But when I sold that put, the prices went up, so I couldn't buy it at lower price. Entered into losses.
Yeah. So that's a problem. You're always going to face your view going wrong. That view going wrong is always going to be there, and so you will never find a clear-cut answer to that. That's why I keep saying that this is not physics, okay? This is not engineering. Engineering, when you have a problem, usually you can figure out what the problem is and you can fix it, and once you've fixed it, it doesn't come again. So here there are no such clear-cut answers in finance and economics, because it's always answered. Like you see yesterday, we had some GDP data out for the US, okay? So the average consensus forecast was 1.9%. 1.9 is the actual data, but the forecast was 1.6. Okay, so 1.6 forecast. So you can see how much of a difference that is. This is just for 1 quarter GDP data. So everything is full of errors, because you can't. It's just like, it's as silly as trying to predict when an individual person is going to die. When the insurance companies predict, they predict for large groups of people. They say that in India, okay, by the age of 75, X% of the population will die, and so on. So those kind of statements you can make statistically for large groups, but you can't make a statement about an individual person, right? So it's not possible. So it's the same kind of problem that you're facing here. Okay, so that uncertainty will never go. So this problem you'll always have. You'll take a view on the underlying asset, you'll find that it goes wrong. You'll take a view on the eyeball, you'll find that it goes wrong. You just have to. That's why I said that risk management is so important. That's why we spend so much time talking about risk management. Okay, risk management is very important. That's how you have to. That's what ensures that you have to control your losses, so that you don't lose big on one particular trade, and you have capital left over to play for other trades, right? Okay, so is this sufficient? Okay, so the same problem. Essentially, you face the same problem by looking at a particular eyeball of a particular option contract. Yeah, but the fundamental problem is the same, and that problem will always got to remain. That's why you need to have, before you go in, you need to have a plan as to when are you going to exit the option. Okay, so either you have a view on you have a point on the underlying asset price which you look at. Okay, here you have a view on the underlying asset price. Maybe you have some view here that if it goes below this, then you will exit the long, you will change your bullish view. And on the eyeball, maybe if you have a view that maybe it goes above this, then you'll change your view. So you need to have a clear-cut plan that if my original plan doesn't work out, what's my backup, what's my risk management plan, at what point do I exit the position? Okay, or you can also have, which I think is less scientific, that you can also have a view that on any option I will not lose more than 25% of the premium. That's a little bit more mechanical, okay, because the market really doesn't care about how much money you paid. Okay, it should be based on meaningful market movement. So I think the first method is better. But you can have that method also. It will not really be a problem in the long run. Okay, all right. And any other, you had a problem about when to take profit.
Yeah.
So when to take profit, the logic is the same, remember? What we discussed for spot?
Yes.
All those take profit elements. So you should have already figured out your trading system from before. You should have already had an estimate, that entire calculation that we went through in your trade risk file. Yes? Yeah, in your calc file, there is a sheet called trade risk, right? So under trade risk, the same exercise you should have gone through before starting your option project. Okay, now your period has been lengthened. Okay, the option project period has been lengthened now, so this is a surprise. But otherwise, you would have known the period. You would have predicted how many trades you're going to do. You would have estimated what is your loss percentage, right? And accordingly, you would have figured out what your total risk capital is, $1 million. Okay, so in that case, you would have figured out what is your maximum risk per trade. So you can just take, one crude way of doing it is to just take the option premium itself, and actually that's a more deterministic way, that the entire, suppose your maximum trade risk is $5,000. In that case, you don't spend more than $5,000 on any particular option. This is the buy side. Now on the sell side, you have to therefore now, whatever price you sell it at, you make sure that you sell the number of contracts, make sure you have a plan to exit where the loss should not exceed 5,000. Is this clear?
Yes.
Yeah, everybody? How we are translating the same logic that we used for risk calculations from the spot trading environment, we are now transferring, because option trading also, the importance of risk management does not go away. You can lose a lot of money just trading options, okay? Because a lot of the options, most of the options expire worthless. So that means most of the people who are buying options are actually wasting their money because they don't get to exercise it, because it doesn't come to a situation where they can exercise it. So this is the statistic in the option market, that most of the options expire worthless, okay? So therefore you can also lose a lot of money. So you therefore still need to have a very, very strict risk management plan. That before you have to trade in the systematic manner, any kind of trading venture that you're doing, okay, you have to approach it in the systematic manner, that what is the period, what is the risk capital, how many trades am I going to do. Those estimates may be a little bit off. You may estimate 180 trades, you may do 200 trades, okay? But I don't think if you go with this kind of a systematic approach, I don't think you're going to get into a disastrous situation. Most of the time you can see problems even with well-known money managers, like, you know, this year, have you guys heard of Ray Dalio? I might have told you to look up Ray Dalio. He has a lot of videos on YouTube. He's one of the leading hedge fund managers. Okay, so you can see how what I kept saying about how this business is so uncertain. Even a top money manager like Ray Dalio, who runs Bridgewater Associates, you might have. Ray Dalio has some interesting comments on organizational behavior also. How to motivate people. They run their company in a very unique way. Okay, they have something called an idea meritocracy. So even from an OB perspective, you can think about that. But Ray Dalio is one of the top fund managers in the world. Okay, they run Bridgewater Associates, but this year they are losing money. Okay, so they are underperforming the rest of the market quite badly this year. So this happens all the time. Even top money managers, many top money managers have returned all their outside money, all the OPM that they were managing. What is OPM? Other people's money. They have returned all their loan. Big money managers like Leon Cooperman, all these people. Okay, they have because they're not able to make money. Okay, and now they just manage what they call like a family office. They manage their own funds because they're all billionaires. Okay, so they have enough money to manage, but they manage their own funds. Even George Soros has returned all outside money. Okay, several years ago, because Soros also faced a situation. Soros is one of the most successful money managers ever. Okay, so he made $1 billion in a couple of days betting against the British pound. Okay, basically shorting cable into the sterling against all the European currencies. Okay, when there was a currency crisis. But even Soros then eventually started making losses, and he got so frustrated. Eventually, he gave up all the outside money and just managed his own money. Because obviously, when you're managing outside money, there's a lot more pressure. Okay, there's a lot more scrutiny. So this problem is always going to be there, and therefore that's why you see that this basically shows you how uncertain the business is. So the main defense that you have, okay, and many money managers have blown up quite spectacularly. People have lost $6 billion in a couple of weeks. Okay, the fund blows up. What you really want to avoid is those kind of disasters. Okay, what you really want to avoid is those kind of disasters where the fund blows up. And if you have this kind of strict risk management, okay, then you will not have these kind of problems. Okay, so the same logic applies. Are you following? Yes. The same way of thinking about risk, the same logic applies. Okay, so your problem of take profit, same logic. Remember, you have to have an idea of how much money you're trying to make, that if you want to use that kind of a targeted take profit. Otherwise you use take profit is only two approaches to it. Either you use targeted take profit, okay, or you use a trailing stop. Remember, we had all these discussions. Okay, so if you use a trailing stop, life is much simpler. Life is much simpler if you use a trailing stop.
Yes, sir.
Right? So if I've gone long here and then the market is here, let's say if I've gone long here and then the market has, when I went long here, my stop was over here. When the market went up and made a new high, I moved my stop over here. So I don't have to do much work. I just have to observe the market and just mechanically keep moving the stop. Okay? And then now that the market has made another new high, I move my stop from here to here. Is this clear? Is everyone following this logic? Trailing stop. Very simple. Initially go long here with a stop over here. Market makes a new high over this. So now I'm able to move it to the next higher low from which the new high is made. Then another new high is made and I'm able to move it to this low. Okay, trailing stop, very simple. Okay, which means you keep following the trailing stop methodology for both your underlying asset price view and your eyeball view, because remember your net option view, whether you sell a put or buy a call or whatever, is really driven, it's composed of the underlying asset view and the eyeball view. So you have to now do this trailing stop procedure on both the underlying asset chart and the eyeball chart. So it's a little more complicated. Obviously it's a lot of work, okay, but once you have the framework, once you have a structure, you can keep on repeating this thing for all the different markets, the same process, right? So then at whenever you have any kind of disruption to your view, you can unwind the option position at whatever the market price is at that point of time, right? But the only problem with this view is you don't really know how much what the option price will be when you finally exit, okay? And the other way to do it is to have the targeted take profit, which you already discussed. I think we discussed it in the beginning of this course, right? Remember, we had the discussion on how to set the targeted take profit. By therefore you have to start with the total profit target that you have and then work backwards with the other parameters of your system. Those videos are already there. These are historical calculations, so you can go back and look at that, okay? All right, does it clear your problem of take profit? There are basically only two ways to go, either targeted take profit or trailing stop, okay? All right, so let's all right, so we were looking at option payoff profiles. Did we finish all the option payoff profiles? Okay, let's look at option chapter 10. Long call we've done. What is this?
Short call.
Who said short call? Why is this a short call? No, you have to say, when you say something, you should not just say it, because after long call comes short call. So, what? No, you have to look at the graph and explain. You have to look at the graph and explain. You have to look at the graph and explain. Why is this a short call? What is it? Yeah? Put option what? Long, short, what? Long. The answer is actually written on the answer is written on the figure. So, but if you want to test yourself, and you want to make sure that you understand the logic, then you should not just blindly read what is there on the chart, because then you're not learning anything. You should try to figure out. First of all, you should try to figure out what is this here actually. That there seems to be a line below the zero line, okay? There seems to be a portion below the zero line. So if it's below the zero line, then what is it likely to be, loss or profit? Loss, okay? So if there is a part where there is a loss showing, then what is it likely to be? Is it a long option position or a short option position? Try to figure it out logically. Otherwise you're not learning anything. You're just mechanically going through the classes. 1 minute. Is my question clear? What is the? I'm trying to teach you a methodology. How will you analyze these graphs? You look at the graph. You see that there is a portion which is below the zero line. Okay, if the zero line, below the zero line, now I'll have to cut marks for Tarun and Srishti. There's too much activity going on. I don't know what, maybe you want to move somewhere. Srishti, come here. No, you guys have been disturbing for a long time actually. So I'll just, is this your? No, you have been talking for a long time. I'm noticing, but I'm in a particular flow, so I'm not disturbing the flow. Where is today? What is today? What is, now why are you going out? Garvit has already gone out. So wait. option payoff profiles. We started here. We'll just put it here. Maybe today's 31:10. Of course, it is your note. No. Session outline is your note. So you don't even know which is your note. You can't become a money changer because you don't know which is your note. Okay. 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 All right. So this should be in bold. Okay, so let's go through the now. First of all, let's figure out an algorithm. Okay, this is like an algorithm, like a mental algorithm in your head, where you will figure out how to answer this question instead of just reading. You've noticed the chart that there is a part below the zero line, so that has to mean what? Profit or loss? Loss. Okay. So if it's a loss, then what is it likely to be? Is it a Garvit, when you go out, please make sure that you come back on time because others are waiting. Okay, good. Every day you go out, you seem to have like this. Okay, now you can go. Okay, so if there's a one minute. If there is a loss, then what is it likely to be? Is it likely to be a long option position or a short option position? Question, Burma. I can't even see you. So, is my question clear?
Yes, sir.
What is the answer to my question?
I think it is long position.
It will be a long position. Why? Why is there, when there is a loss, why is it that when there is a loss, it should lead me to infer that this must be for a long position?
Those I think will be short position because.
Now you changed your answer.
Yes.
Kanika, what is your answer? Is my question clear? I look at the chart and I see that there is a part below the zero line which is flat. So it's this flat part below the zero line. Okay. So it seems to be showing a constant negative quantity in some scenario. This is just a scenario analysis. This is an expiration diagram. This is a scenario analysis. Okay. So in one part of the graph, which is a many scenarios, it seems to be showing me a constant negative quantity, not a growing negative quantity, but a constant negative quantity. So if it's a constant negative quantity being shown in quite a few scenarios, okay, then is this likely to be talking about a long option position or a short option position? Yes. Is my question clear now? You can see the graph. Yeah. Short option position. Why? What? Because it is showing loss. But it's a constant loss. So do you have a constant loss in a short option position? This is showing it from the trader's point of view. The person, either he has sold an option or he has bought an option. Okay, anybody? Srishti? What is the answer to this question, this part of the question? Is it a long position or a short position that is being portrayed here?
Short position.
Short position, same as Kanika, same as Verma's second answer. Why?
So because there is constant negative quantity.
So short position, in a short option position, do you have constant negative quantity? How will you have a constant negative quantity? Okay, let's not waste now. This is the problem. This is why I prefer to use lecture. Now I hope you guys understand, okay, that you have to remain interested, okay. I can't have maybe a lecture, an interactive method like a case discussion method is more engaging, okay, but it takes up a lot of time, right? So you can see that. This is why I generally, you have to be interested, and it's not my job to make finance interesting to you. Okay, now let's quickly answer. Now Tanya, what is the answer?
Long position.
Why?
Because the premium has been paid before.
Okay, so it's basically it's a long position because the long position is showing you the situation, the constant loss. The premium is a constant premium. Once you pay your car insurance premium, the insurance company it's too fast. It's too much noise. Garvit, we can't have that. It'll disturb the audio. It's disturbing me. Just reduce the fan speed a little bit. The AC is also running, right?
No, sir, AC is not working.
No, I think that's still too loud actually, because maybe at this point, I don't know which one is it. There's too much noise. I don't want so much noise. Just reduce it one more notch. Yeah, that's fine. Okay, now guys, let's not make so much commotion here now. Let's concentrate on what's going on. Okay, so it should tell you straight away that it's showing a long position profile, because in a long position, what do? It shows it from the trader's perspective, okay? Not the opposite guy's perspective. The trader, what is he doing? And he's buying an option, then he's putting up some premium, and that premium is constant. Once you have paid the car insurance premium for 1 year, the insurance company doesn't come and take more premium from you after a few months. You have paid it once upfront. So it's a constant loss, means this must be showing the situation where the parts where the scenarios where the option is expiring worthless. The option is not being exercised. So if I have paid car insurance premium and I don't have any, of course I don't get a net benefit anyway, but if I have bought, let's say if I bought an option and I don't exercise the option, then because the market doesn't move in my favor, then what happens? My option premium is a loss, but it's a constant loss, right? So in all these scenarios, what it is showing you is this is the constant loss, where when in this case this is the put option with a strike price of 70. So if I bought a put option with a strike price of 70 and the market price is 100, will I exercise the option? Yes, Gulati?
Sir?
Will we exercise the option if the put option is strike price of 70 and the underlying asset price at expiration is at 100? Will I exercise the put option? What happened? You're focusing on something else. That's why you're not.
Sir, in the last class, we went from a similar situation where I said we will exercising it, but I was having a -$7 loss, whereas Sakshi had a -$5 loss. So I'm getting into that dilemma.
No. Where is the question of all that? We are now at 100. I'm talking about a scenario where you paid whatever price you paid for the option, okay? You paid $7 for the option. The strike price of the put option is $70, and at expiration the market price is 100. The question is very simple: will you exercise the put option or not? Right? Why will you not exercise?
Sir, because then I will be having a loss of around 23.
No, your loss will not be. You will not have a loss. Okay, again, it doesn't work like that. First of all, this is the right way to think about this answer, and the right way to answer. Remember, you have to always talk to a computer. Okay, so if I'm asking you, if you bought a put option with a strike price of 70, and the option is, and the underlying asset price at expiration is 100, will you exercise the put option? So the answer to that should be, to a computer, the put option confers on the holder the right to sell at the strike price. Okay, in this case the put option holder has the right to sell at 70, but the market price is 100. So why would he sell at 70 when he can sell at 100? So therefore he will forego the option, he will forego the right to sell at 70 because he can sell in the market at 100, and he will let the option premium, whatever was paid, that goes for a toss anyway. Okay, that's a loss. Okay, so that's why, and you paid how much? $7 premium. So that's why when the other day when I was plotting bit by bit, some people were wondering why Hardik was wondering, why am I plotting like in baby steps? You watch this, then draw parallel, then draw perpendicular, because I want to make sure that people's fundamentals are clear. So you're doing a scenario analysis here. This is a scenario analysis. Okay, you bought a 70 put with a price of $7. When the underlying asset price at expiration is 100, you don't exercise. Therefore, what is the loss? And the other rule in these expiration diagrams, hockey stick diagrams, is we don't account for the time value of money. Okay, so therefore, when the underlying asset price is 100, you don't exercise the option. So your PNL is -7. Is this clear to everyone? Okay, so your PNL is -7. So in all these situations, you don't exercise up to 70. Up to 70, you don't exercise, and therefore up to 70, your loss is 7. Is this clear? Are you following now, Kanika?
Sir, actually, I won't exercise up to 77. I won't exercise up to 77.
No, not 77. Not 77. Okay, this is also another twist. So we'll one minute here. Okay, so now here also I have to cut marks. Garvit and there also you have just also a lot of time. We have to separate you two also, Garvit and Adarsh. There's too much. I try not to waste time on this, but okay. All right, guys. Okay, now Gulati has thrown another curveball. He is now saying that we should exercise below 77.
About 77.
1 minute. We are talking about a put option. Okay, let's be clear. We are talking about this option.
Yes, sir.
We are talking about a put option for which we have paid $7, and the strike of the put is $70. Okay, so now you are saying we should exercise this put when
The exercise strike price is 77 or above.
no, strike price doesn't move. Once you see,
Market price.
don't say exercise price, market price. Exercise price is not market price. Exercise price is strike price. You can say that, okay? But are you? So let's get one thing very clear. Once you have bought the option, then all this stuff like exercise price, expiration date, call or put, all these things are frozen. You can't change them anymore. What changes is the underlying asset price keeps moving around and the eyeball keeps moving around. Okay. So now we're talking only about the underlying asset price. So you bought a $70 put, you bought a 70 put for $7. Okay. Now the underlying asset price is at 100. So now you're trying to give us a rule as to when we will exercise with respect to the underlying asset price. So what is the rule that you're giving us?
According to me, we should go any price above 77.
So let's say 100 is above 77.
And
100 is above 77. So at 100 we should exercise.
yes, sir, we should exercise.
We should exercise the put option.
No, sir, we should not.
Why?
Below 63. Below 63 is.
Okay. Let's first 1 minute. First. Okay, let's first satisfy Gulati. Okay. Make sure he is clear. Are you satisfied with the answers that we are giving you? Okay.
Sir,
You are saying that we should exercise above 77. So 100 is above 77. So you're saying I should exercise a 70 put. The 70 put gives me the right to do what? To sell at 70.
yes, put means I'm having a right to sell.
Yeah.
But I'll be selling that put option somewhere, like if I'm having the market price at 77, if I'm having a right.
Now we're not talking about 77. We are talking about 100. You said anything above 77.
Yes, sir.
So we have taken 100.
Okay.
100 is above 77. So at 100 you're saying I should exercise.
Yes, I'll sell my put option
You'll sell your put option.
because it's giving me a right to sell.
We are not talking about selling the put option. We are talking about exercising the put option. They're two different things. Remember that that's why I have forbidden you from exercising early exercise in your project. Because most of the time it does not make sense to do early exercise. Okay? Most of the time it doesn't make sense to do early exercise because you will see that even out of the money put options, even out of the money options have some time value. Right? Okay, so if you exercise the option, you capture only the intrinsic value. If you go back here, I don't know where it is in your notes, maybe we can go back a little bit. It's a long way back. Where do we have intrinsic value? Yeah, here. Okay, guys, here, look at this. Let's revise all this stuff again. So, a lot of the basics. See, this is what I mean by you need to go back and revise continuously and satisfy yourself in your head that you have understood this problem, you have understood the entire thing. The total value of an option consists of intrinsic value and time value. Why have I told you not to exercise options early? Most of the time we don't generally exercise, even American options, there are some exceptions, but in general we don't, because the value of the option, okay, here we are talking really about the price of the option, so we should use the price term, but So let's say the price of the option is equal to intrinsic value plus time value. Intrinsic value you have understood is the profit you can make by exercising the option right now. Okay. So then even when there are out of the money option, okay, like this one. This is a 70 put and the market price is at 100. So this option is in the money or out of the money? Shivam? Is this option in the money or out of the money? Out of the money, right? So out of the money options, they don't have any intrinsic value, okay? We can just say zero intrinsic value, okay? But this option, let's say there are like 150 days to expiry. This option will still have some time value.
Yes, sir.
Okay, because 150 days, basically the time value reflects the fact that in 150 days this option can move into the money. That's why there is time value. Okay, have you understood this? Why is there time value for out of the money options? You can say this option is out of the money, there should not have any value. Okay, but it's got 150 days to expiry. So a 70 put when the market price at 100, it has no intrinsic value. Okay, because you can't make any profit by exercising it. But it's still, if the put is like a 150 day put, it will still have some time value, because and that time value reflects the fact that in 150 days all kinds of stuff can happen, right? So the market can suddenly shoot up or suddenly drop and the put can have value. Okay, so therefore that is what is being reflected in the time value. Okay, so therefore that is why one of the reasons for, so first let's recap this. The main reason I'm telling you that one is to avoid the complexity, but second, in general we don't exercise even American options early, because if you exercise the option, how much do you capture? Only the intrinsic value. Okay, because you'll exercise, that's what intrinsic value talks about, basically how much can you make by exercising the option right now, okay, and squaring your position in the market. Okay, but then if you sell the option one alternative is for you to exercise the option. Okay, Gulati, pay attention, don't look at your phone or whatever, so then you'll understand the problem. Okay, so one alternative for you is to exercise the option early. Okay, when you're sitting on in the money option, you have two alternatives. One is to exercise the option early, and the other option is to sell the option in the marketplace. Yeah, the other option is to sell the option contract. So Gulati, make sure you understand this difference. There is a difference between selling the option contract in the market and exercising that option. Okay, yeah, because when you're selling the option in the market, you're not getting into any kind of involvement with the underlying asset. You bought an option and you're selling the option, or you sold the option, you're buying back the option. Okay, so therefore you don't have any involvement with the underlying asset. If you are exercising the option, which is the other alternative, okay, in that case you're getting involved in the underlying asset market, because you're exercising the put option, which gives you the right to sell the underlying asset. Okay, and then you're selling the underlying asset and then squaring that short position in the market for the underlying asset. So you get involved in the underlying asset. Okay, so in one alternative you exercise the option, and in one alternative you sell the option in the market. The reason we generally say that most of the time we don't do early exercise is because if you do early exercise, you'll capture only the intrinsic value. Are you following the scheme?
Yes, sir.
Make sure everybody understands this, that the price of an option contains two parts, the intrinsic value and the time value. Okay, so even out of the money options have time value, because it reflects the fact that, which is partly a function of the eyeball and partly a function of the expiration length of time. Okay, so more length of time means, greater length of time means more time value, because that much more time for all kinds of stuff to happen, right? So therefore, if you sell the option in the market, you capture both these elements. If you sell the option in the market, you will capture both the time value and the intrinsic value, because they are reflected in the option price. Are you following what I'm saying?
Yes,
Kanika, pay attention to what is being discussed. I think we'll have to make you also a permanent member of the first bench, because you're not paying attention, getting lost in other stuff. So is this clear? The price of the option will always reflect both intrinsic value and time value. So if you sell the option in the market, that second alternative, you capture both the elements. Okay, and if you exercise the option and to go for the first alternative, then you're capturing only the intrinsic value. Okay, so in general you'll always, there are some few exceptions, but in general therefore the second alternative is always better, because you're capturing more value. Right? Are you following? Is everyone clear about this? This part you have understood now, Gulati? Now, you come back to your point. You're saying $70 put. So let's get this clear first, okay? That when the underlying asset price is at 100 and the strike of your put is 70, you're holding a 70 put, okay? You will not exercise it because by exercising, what are you, when you have a put, you have the right to sell the underlying asset. So the logic should be like this, that a put gives you the right to sell the underlying asset at the strike price. Here the strike price is 70, but the market price of the underlying asset is 100. So why will I sell something at 70 when I can sell it in the market at 100? So I would rather let my whatever premium I've paid earlier, let it just lapse as a sunk cost. Okay, I don't want to do this extra, generate this extra loss. Okay, here the option has no intrinsic value. Okay, or zero intrinsic value. Is everyone clear about this? So now we come to the other point that you are trying to get at, okay, which is we need to evolve some kind of rule as to, which is now the kink in the curve, okay. So remember, one of the things, let me show you here, that if we go back to our, where is the, yeah. Okay, this always needs to be made smaller. Alright, now we can see this. So which type of instrument have we classified as having non-linear payoffs? Options, right? Only options have been shown as having non-linear payoffs, okay? So why do we use, so you now get to know one more part of this framework. Why has it been written here? Why has it been written this way? This part is very clear, that all these other instruments I'm trying to indicate by this, that these are all linear payoffs and this is all non-linear payoffs. Why do we say that? If you look at the payoffs, of course, here we are looking we at profit profiles or payoff profiles in this chart, figure 10.2?
Market data connection re-established.
Are we looking at profit profiles or payoff profiles? Yes, Sukriti? Are we looking at profit in 10.2? Are they showing a profit profile or a payoff profile? Profit profile. Why not a payoff profile? What is the difference theoretically? What is the difference between a profit and a payoff in the context of options? You forgot it. We have discussed this. It's in your notes also. Yes?
Profits are adjustable premium. Payoffs are adjustable premium. Profits are maintenance. Payoff is difference between the underlying price and...
One minute. Let me hear what, maybe you can use the mic. Yeah. So is everyone clear about, see, basic questions, and this has all been covered before. So if you're a serious finance student, you should be, your attitude should be, okay, this concept was touched upon. I think you're smart enough to understand that this is a concept. Is that correct? You have understood, you have detected that there is a concept being discussed here. So you should be clear, your attitude as a serious finance student should be to go through the notes and the videos, see wherever there's a concept being discussed, that you can easily detect that there's some concept being discussed here. Your job is to be clear about the concept. Once you're clear about the concept, you don't have to study for the exam. Everything is clear, you'll know it for life. Okay, but you guys are not doing that. You have to pursue it like that. You have to pursue the knowledge aspect of your career as a finance student. Just getting grades and taking a degree and then putting on a suit, going for the interview, that doesn't make you that's not a strategy for long-term success. Okay, you have to master the concepts. Okay, yes, Parul.
Payoff is the difference between the strike price and the underlying price, and profit is when we
Market data connection re-established.
from the payoff is profit.
Okay, correct. So she has given the right answer. That profit, the payoff just shows you what is the difference between the underlying asset price and the strike price. So if you draw a payoff diagram, essentially what will happen is this part will shift up. okay, this basically the loss part will disappear, okay, in a payoff diagram, okay. So you'll see there are some payoff diagrams below, if we can see them. Maybe, yeah, these are the payoff diagrams, okay. These are payoff diagrams, because here you'll notice the payoff diagrams, they don't have that part below or above the zero line, okay, because the premiums are not being reflected in the payoff diagrams, okay. So the profit is basically nothing but the payoff is like a gross profit, profit is like a net profit. You can think of it that way if you want to think of it, okay. So the payoff has been adjusted by the premium to give you the profit, okay. So that's the basic concept, which we already covered it, okay. So now let's say, why did I use the word here non-linear payoffs, okay. In the markets normally we use the word payoff, but you can also have profit profile. The statement will still be correct, okay. So you can, for the purposes of this discussion between linear and non-linear, we can just have we can use either payoffs or profits for the purposes of this discussion, okay, because the chart will look the same. Why is it non-linear? You notice this particular kink, we are departing from our existing discussion on the particular put and the profile, but here we are just trying, I'm just trying to highlight one more part of the learning, linear versus non-linear instruments. Why are options, and sometimes what happens in the market is people will just say options are non-linear instruments, okay. This is just a shortcut. What actually they should be saying, to be very, very strict, is they are instruments with non-linear payoffs. Okay, but this is how we talk normally, because we just omit one word. But you have to be very clear that whenever you're saying options are non-linear instruments, what you're really saying is they are instruments with non-linear payoff profiles or non-linear profit profiles. Why do we say non-linear? Because you can see clearly there is a kink in the curve. It's not a straight line, okay. So that's why when you look at that framework, why have they been listed as non-linear payoffs? Okay, because this is the reason. Okay, because there is that kink. Okay, because there are certain situations. Now we'll go back to that. So this is just to show you, and you will see later on when we come to futures. We have it here actually. We can just, since I've taken a departure for this, I'll just do this, I'll just cover this topic. So whether you look at payoffs or profit profiles, just look at payoffs for this. So you can understand why options are called non-linear payoffs, instruments with non-linear payoffs, okay. So loosely people will just say non-linear instruments. Now, why are all the others linear payoffs? Why do all the others have linear payoffs? Let's understand that. This is also an important part of the learning. So once again, this becomes a concept, okay. You have to make sure that you're very clear about this concept. These are all small concepts, modules that we are discussing. Your job is to make sure that you understand the concept, not just read and memorize and try to do something in the exam. Okay. So this is so everyone is clear why options are called non-linear, because there is a kink in the curve, in the payoff curve. Now let's look at, this book is also in your finance reference from the last semester, CME option strategies, 25 option strategies. So I will not have time to cover all this. Your job as a serious finance student is to make sure that all the basics, fundamentals which we are covering in the class, you're clear about that, and then you use all these references which I've given you. Then the Sheldon-Nattenberg book is also a very good book. Okay, Hull you can read a little bit, but Hull is not of great practical value. Okay, there's some information there. The really good book is the Sheldon-Nattenberg book on option volatility. If you really want to get deep into option trading, okay, that's the book that you should read. Okay, and there's another good book by Baird called Option Market Making, that is even more technical, slightly more difficult, higher level of difficulty than the Nattenberg book. Anyway, let's look at this. So now I'm trying to show you why do we say that all the other types of instruments, in this case we are talking just about futures, okay. Let's just talk about spot, and this will be easier to understand, okay. In this book it's being shown for futures, but all these things, spot, futures, forward, swaps, all of them we say linear payoffs. Why? Let's look at it this way. Okay, so this is, let's say, a spot instrument, okay. So let's say I've gone long the spot at this point of time, okay. I've gone long the spot at this price. So this is the spot price, okay, and this is the PNL, the same kind of plot that we saw in the payoff diagrams, okay. Here you have the PNL, you can see plus minus below the zero line, okay, and this thing is just the underlying asset price, same kind of plot. Okay, underlying asset price. This is there in that CME option strategies book. This is page 6. Okay, I'm just looking at I'm just trying to show you here why for spot, futures, forwards, etc. all will have the same kind of profile. Why do we call them linear payoff profiles? This is why. You can see this is linear, this is straight line. Okay, now let's understand this clearly, why this is linear. Okay, suppose let's just put some numbers on it. Let's say this is 100. Okay, so A is equal to 100. Let's say A is equal to 100. So I bought, let's say I bought the common stock of Microsoft at 100. Okay, now I do this is a scenario analysis chart. This is also just like the payoff profiles and the profit profile. This is scenario analysis. Okay, so I bought the thing and we are not accounting for time value of money. So I bought it sometime, let's say I bought it 3 months ago, and now 3 months later, let's say the price. So how is this plot generated? Obviously this is generated by joining a whole bunch of dots which are falling like this. We join them and form a straight line. Okay, so let's say how did this dot come about? Okay, so let's say this is 100 and let's say this is 180. Okay, and let's say this is so this is 180. Okay, so I bought it at 100 some time ago, and then now when I'm calculating my P&L, I find that the underlying asset price, that Microsoft common stock, is at 180. So am I making money or losing money? Making money. So I bought it at 100, now it's at 180, and how much money am I making? 80. So this plot is basically a scenario analysis. It's supposed to show me my P&L for different values of the underlying asset price. Okay, very simple. Okay, so here when the underlying asset price value is 180, I calculate that I've made 80 minus 100, 180 minus 100, I made $80 profit. Okay, so here I drop a perpendicular, this one should be here. If you draw the parallel, this should be 80, excluding commissions and all that. Okay, this will be 80. All right, so similarly now let's look at let's say this is at this point, let's say the market is say 40. This is $40, this price. Say this is $40. Okay, so how is this plot coming about? This is $40. So if I bought the stock at 100 and the price now is $40, am I making money or losing money? Losing money. How much? $60. Okay, so I'm losing $60. So against this value of 40, I have to plot against here. There should be $60. Is this clear? So if you plot it like this, if you do this exercise for yourself, you can do a spreadsheet and calculate different values, and then you can just use the spreadsheet graphing features and see and generate the graph. You can test it for yourself. I'm just trying to save myself that time. Okay, but you will see that if you take a spot equity position, okay, or even if you take a futures position, okay, not accounting for time value of money and funding costs and all that, okay, if you draw a simple payoff profile, you will get this kind of line. Is everyone clear?
Yes.
Are you following? You plot it yourself and see for your own feeling, to get the feel of the whole thing for yourself. Okay, but you will get this kind of profile. This will happen whether you're doing futures, spots, forwards. Okay, all of them will have this kind of payoff profile. This is the payoff profile for long underlying asset. For long underlying asset. Okay, let's look at. This is shown in this book as long futures. This is your first diagram, but long futures, long spot, long forwards, as far as the payoff is concerned, without time value of money, same output. This book is there in your finance reference. You can download it. Okay. Now let's look at this. Okay, so you already got the answer before, that it is short futures, which means it is short spot. Okay, so we'll take the same example. So let's say I'm short Tesla and this price is, let's say, $200. So if I'm short Tesla at $200, okay, and then when I calculate my P&L, okay, the underlying asset price is $140. Let's say this is 140 here at this point. It's 140. So am I making money?
Yes.
Or losing? I'm making money. Okay, so I'm making how much? $60. Not counting commissions, I'm making $60. Okay, so here this one should be showing this level against a plot of 140. The plot here on the prop P&L axis should be showing $60. Is this clear? Okay, now if you show this is, let's say this is 280. This let's say this price is 280. Obviously it's not to scale. when I'm pointing out this stuff. So this is 280. Okay, at 280 you're losing $80. Okay, so then the plot here should be minus 80. Okay, is this clear? So if you plot the short futures, short spot, short futures, any kind of short forward, that's why these are called linear instruments, because you see that the payoff profile is linear. You don't see the kink in the curve that you see with this. Both are in PDF. Here you see the kink in the curve in the case of options. Okay, whether it's a payoff curve or the profit curve. Okay, you see the kink in the curve. That's why it's called non-linear. Okay, and this one does not have a kink in the curve, so it's called linear. Okay, so this is another concept that we should be clear about, that why are options called instruments with non-linear payoff profiles, and all the other stuff, spot forward, futures, futures swaps. Okay, all those we call them futures forward swaps. We call them instruments with linear payoff profiles. Is this clear? Okay, so another concept that you learn, and it is made so easy for you that now we can go back, we can make this bigger. It's at 100%. Okay, so it's made so easy for you that everything is, how do we search, get ourselves, we'll search for others and come here. Okay, all right. So another concept that we have learned, all the concepts are written down for you as subtopics in your notes. So you know already, you're getting a heads up that this is a concept. I better be clear about this concept. Okay, so you have to struggle with yourself, and learning a concept obviously is hard work. Maybe you're not used to it from your undergrad days. Okay, but you have to make this transition because you're now studying for a professional degree. Companies don't care about what degrees you have or what grades you got. Okay, companies care about what you can do, how clear your concepts are, how confidently you can operate in the workspace, right? So therefore you have to be clear about your concepts. That's a new way of learning. You have to push yourself to understand, and understanding concepts is always difficult. Okay, it's much harder than just mugging stuff up. Okay, I'm just coming to you. So you make sure that you do it this way, otherwise you're wasting your time, you're not getting value from the program. And once you understand the concept, you'll understand it for life. You don't have any and you can build further on that. Okay, yeah, you the mic, use the mic.
So futures is another type of derivative. So why doesn't it has a kink?
Why doesn't it have
a curve, kink in its curve?
Because what is the let's go back one second. Okay, I need not have done 75. All right, what is this graph showing you with my imperfect diagramming capabilities? But what have I tried to show you here? That this linear payoffs covers all these from cash to swaps. So here there is a little bit of overlap, you see. Now futures, forwards and swaps are derivatives, but they are not derivative. All derivatives do not have non-linear payoffs. What is the format? What is the graph framework showing you? All derivatives do not have linear payoffs. So the characteristic of a product, when you're looking at a product or an instrument, sometimes we refer to these as products, okay, or instruments or types of contracts. These are just specifically with your legal background as well. You should think of it as particular types of contracts. Okay, contract will have terms that confer certain types of rights. Okay, so that's where the unique nature of these instruments comes from. So now these are all derivative markets. So all derivative markets do not have non-linear payoff profiles. All derivative instruments do not have non-linear payoff profiles. What is the framework showing you? Framework is not showing you that all derivatives have a linear. So the fact that an instrument is a derivative product, the property of being a derivative product, okay, is independent of the property of being a product or instrument with a non-linear or linear payoff profile. This is a totally different aspect. Okay, it's like saying you are an MBA student and then do you have high power, do you have glasses? Now all MBA students may not have glasses. Okay, so it's a totally different aspect of your identity. Okay, is this clear? Okay. Yeah, but anyway, it's a good question, because anytime you have any kind of doubt, you should ask the question. That is how you learn. That is why, that's the only reason you come to class, for the privilege of asking questions. Otherwise, you can just sit at home and watch the video. Okay, so we go back to our full 100% size. Okay. Let's go back and quickly do these exercises. So where is Gulati? He has disappeared. he has disappeared for a long time. It doesn't seem to have, I don't know where he has gone. Send him a call. Send him a call for. Don't go out. Don't use that. Garvin is looking for excuse to go out. You send him a message to come back. Where has he disappeared? Okay. So this stuff we had actually already covered before. Okay. Then we are covering it again because we are noticing that some people are not clear. I think we'll have to move a little faster now because you have to just go back to the videos and teach yourself and make sure you're clear about the concepts. Phone is also in the class. Okay, never mind. Fine. Okay. So, all right. Now, but the Gulati did raise an important point, which is he was trying to figure out a formula. He was trying to figure out a formula as to when we will exercise. Now that formula, that actually the question has already been answered by Sakshi Agarwal in the previous or 2 classes before, which is that you will always look at, so at what point do you exercise? Okay, when you are looking at the strike price versus the underlying price, okay, what point do you exercise? Essentially, whenever the rule will be that whenever there is any positive intrinsic value, you should exercise. Is this clear? Okay, you also went out, even though Gulati had also gone out. Our door, he is nowhere. Okay. Don't go out for such long periods.
I had to go upstairs because he was cleaning inside the washroom.
Okay, fine, no problem. But just keep an eye because when you go out, I don't know how Bharat slipped out, but okay. So we should hand over all this stuff to robots. So the robot will stop you at the door. When one guy has gone out, the robot will count the students in the class. Okay. Now, all right. What were we talking about? Coming back, Gulati. You're back in time to answer your question. To the answer to your question. Okay. So. Now learn this also because you were not clear about it. Okay, so we don't have time to go through a long interactive discussion. Okay, but we will just give you the answer. The question but you did raise an important point. You were trying to figure out a formula to decide as to when I should exercise, whether it's a call or a put. Can we come up with a general formula? And the general formula is, which Sakshi had already essentially highlighted for us the other day, which is that you will look at, it comes from, the formula comes out of basically doing this exercise, figuring out the 2 alternatives. Either you don't exercise or you exercise. Okay, so if you don't exercise, in this case, let's say when the price is you're paid $7, so the price is 68. Okay, so if the price is 68 and your strike is 70, okay, if you don't exercise, then you lose $7. Okay, but if you exercise, you sell. Exercising gives you the right to sell at 70. You sell it at 70 and immediately square your position in the underlying asset at 68. You make a $2 profit. Is everyone following the steps? One alternative is not to. The underlying price is 68 at expiration. You're holding a 70 put. You paid $7 for that. Okay. So in this case, you have 2 alternatives. Either you don't exercise. Okay. Or if you don't exercise, you lose $7. Is that clear?
Yes, sir.
You paid $7. Now, if you exercise, then you get to sell at 70 and immediately you can square the underlying asset at 68 in the market. You can buy back at 68. So you make a $2 profit. Is everyone following? Please nod aggressively so that I can,
Yes,
yeah. That's what, like, imagine that I'm paying head banging music or something. So everybody nod like that. Yeah. So because I need to see clear indications. People are sitting like zombies in the class. I need to figure out whether you have understood or not. How will I? What? Near Halloween. No, because I need to, because one of the problems I have is I find it very difficult to move on if people are looking blank. How can I just move on to the next topic? Okay, so you need to give me a clear-cut indication that you have understood, okay, so that I can move on. Okay, guys, this is an important point. Okay, so if you don't exercise, you lose $7. If you exercise, you sell at 70. Okay, you sell at 70 and immediately you buy it back at 68. Okay, so you make $2 profit. So your net PNL is now -5. So instead of the other alternative where you're losing 7, Okay, so therefore you should exercise in this situation. The rule is basically you can look at what is, if there is any positive intrinsic value in the option, you should exercise. This is the rule that you're going to apply. Is this clear? For the exercise part of the rule. When should you exercise? Is this clear?
Yes, sir.
Okay. So quickly running through, make sure you go through all this stuff. Payoffs and profit profiles. I'm not going to go through all this in great detail. Profit from, now whenever you look at now, so the formula I was trying to teach you some basic principles. How to identify, okay? Now you're seeing a constant, this part is a profit or loss? Constant profit. Constant profit means immediately it should tell you that this is talking about what profile? Long or short options? Short options. Because when you go short options, like the insurance company selling car insurance, when you are going short options, you collect money because you get the premium. Because when you are going short, the other guy is going long, that fellow has to pay you the premium. So if you're seeing any line above the zero line, constant amount above the zero line for many scenarios, that means these are the scenarios where you're collecting upfront premium as an option seller, and these are the scenarios where the other fellow has no incentive to exercise the option. Alright? So another way you can figure it out is, see, if you see this, how will you figure out whether this is a call or a put? You look at this, you can see straight away this is a short position in an option, either call or put.
Yes.
Because only in a short position do you have a constant profit scenario. Okay, because the premium is there to you, where they're available for you when the other guy does not exercise his option. Okay, so and then you see which part of the strike. You can see the strike is 100. Okay, now below the 100 strike, when the price is below 100, since Garvit is getting restless, we should take a check on the time, and you guys should also look at this message that comes up on the if you put in a bond price. We'll do that some other time. Okay, but look at this, one more formula that I can give you, one more way of thinking about it logically. It's not a mugging kind of approach. Which part of the graph is showing up constant profit? Constant profit means straight away short option profile. Could be a call or a put. Now is it a call or is it a put? Now another way to think about it, which part? It's a 100 strike call. Okay, and this, remember, this constant profit scenario straight away means what? That you collected car insurance premium and the car did not crash, so you just pocket the premium as an insurance company. Okay, no claim to be paid out, right? So this is a situation where that means all the strikes below 100, the other guy does not have any incentive to exercise the option. Okay, so if the other guy is not exercising when the underlying asset price is below the strike, when do you not exercise? When the underlying asset price is below the strike. When you look at this strike price of 100, okay, when my question is, I've not phrased my question properly. Okay, my point I'm trying to emphasize here, you can think about this later and work it out for yourself, that the constant profit is being shown for strikes below 100.
Yes, sir.
Okay, the strike price is 100, you are the seller of the option. Okay, if the other guy is not exercising the option when the underlying asset price is below the strike, okay, that means what kind of option is it? Call or put? Has to be a call, because the market is below the strike price.
Yes.
So what is the guy saying? Why is he not exercising? He's not exercising because he's saying the market price is below the call strike. So why should I buy at 100 exercising the call?
Yes.
By exercising the call when the underlying asset price is $80, let's say, or $90. Is this clear? Are you following the logic? There are different ways. By going through these kind of exercises, you can also learn more about, you can solidify your learning about the basics of options. Because as we can see, even the basics are not clear for many people. Right? You need to work on your basics. The basic foundation has to be first clear. Then you can build on it on your own later on. Is this clear? Okay. Now we can let you go.
Thank you.
One last point I'll mention about this, then you can see. 1 second, just give me 1 second here. Look at this. Bonds trading on alternative trading systems. Okay, so here these quotes are not trading quotes. I've got a price of a Tesla bond in here. That's why this is showing. Okay, I have to hit OK here. These, when you look at alternative trading systems, okay, these are known as indicative prices. Okay, should know this term. These are indicative prices. These are not firm prices. These are firm prices. These are futures prices. Okay, these are firm prices. You can trade on them. There's a difference in the market. You should know these terms. Did you know these terms? Indicative price versus firm price. When you listen to broker voice boxes in a trading room, the broker will be asking, are you firm? Are you firm? Which means, can I hit you on that price? Or is this an indicative price? So these Tesla bonds, these are Tesla corporate bonds with a coupon of 5.3% due in August. It can't be August 15. 2015 has already passed. Yeah, 2025. 5.3% coupon, Tesla bonds due 2025, 15th August. Okay, these prices are indicative prices, which means you can't trade on these prices. You will have to do what is called an RFQ, request for quote. Okay, basically a request for a firm quote, and then you will be able to trade on it. This is again an aspect of markets. You learn something else also new. Indicative prices versus firm prices. Firm prices are also called dealing prices. Okay, the broker may be might ask you, is that a dealing price? Okay, this is clear. Okay, so I've taken 3 minutes extra of your time. Let's hope the video